Hello everybody, this is Daniel Zabala, and in this video today we're going to be talking about technical analysis and what it is and how it works. So this is level 5 of the 10 level financial education training course that I'm putting together on my YouTube channel. Please like, share, and subscribe, and please keep in mind all my content is for educational and entertainment purposes only. So let's dive right in. So what is technical analysis? So there are different types of analysis for different trading and investing activities. These are the ones that are commonly used in the industry. So we're looking at technical analysis today. It primarily looks at past volume, past pricing of stocks and underlyings, and other data that will ideally give you a directional bias when placing a trade. Okay, so technical analysis is primarily used for short-term trades, and the way we're going to be talking about it primarily, we're talking about more for swing trading. Okay, so if you're investing for the long term, you're going to be concerned mostly with fundamental analysis, how to pick high quality investments like companies and stocks to determine their current value relative to their potential future value to invest for long term. If you're swing trading, specifically using options or derivatives products, then you really look at statistics or quantitative analysis. That is a great tool to use when doing swing trades using options. Or volatility analysis is another type of analysis. Mental analysis has to do with both internal psychology as well as external, looking at what the market psychology is showing us. But we're talking about technical analysis. And within technical analysis, there's price action, and volume analysis, which is mainly what you use for day trading. And then there are technical indicators, which are less useful for day trading and more helpful for swing trading. So these are the three that we're most concerned with. They all fall under technical analysis, but specifically price action, volume are for day trading, and then all three really for swing trading. Technical indicators. So these are some of the most popular indicators and ones that I personally like and use or will look at from time to time for swing trades. Okay, so we're looking at volume, VWAP for day trading specifically, that's the volume weighted average price, RSI, ADX, the TTM squeeze, which is a combination. It's one indicator that combines these three indicators. Bollinger Bands has to do with standard deviation, so it kind of has the aspect of volatility and statistics built into the indicator itself. Moving averages, previous day high and low, especially for day trading specifically. The ATR is the average true range. That's the average range of the stock price or underlying price within a single day over the last 14 days. So what's that average price of the last 14 days, the average range on a day-to-day basis? And that's useful for both day trading and swing trading, and the others you see here. So this chart I pulled from a little while back and actually don't use the choppiness indicator. I just had it on my chart for the time being to kind of look at and experiment with it, but I no longer see the need for it with the other indicators. The less indicators, really the better. Price action and volume are always your best indicators when trading, day trading especially, even swing trading. But when it comes to swing trading, these other technical indicators can be helpful to give you an idea of where the market might go. Another important thing to look at when day trading or swing trading is using multiple time frames. This is super important. You want to ideally be using at least 3 time frames when you trade, especially swing trading. But even day trading, you want to see, if you're only looking at a 1-minute chart, for example, this is a 1-minute chart, your perspective is very limited. You kind of have visors on. You need to see on a bigger time frame, like the 15-minute chart, what's going on. This orange to purple line is the whole 50 moving average, where it kind of changes on its own based on direction. We see the price actions below that on the 50-minute chart. So we wouldn't, the way I trade personally, I wouldn't want to take any long positions if the price was here below the 50 moving average. If it was above, then sure, maybe go long. But if we're going short, meaning we're going to sell the stock, or the ETF in this case, we'd only go short if it's below this 50 moving average, as an example. So using multiple time frames is really important to make sure that your trade is in line with the overall direction or trend that you're trying to trade with. And we're going to get into, in a moment, the different market cycles, which actually we're going to right now. So different market cycles, we have to keep in mind as traders, even as investors, there are three types of market cycles that constantly repeat themselves over and over and over again. This applies to individual stocks, it applies to indexes like the S&P 500, it applies to commodities, anything and everything this can be seen. So the market cycle is periods of oscillation, or also known as consolidation, which is a chopping sideways, which the market spends about 66% of its time, or any individual underlying about 66% of the time, in periods of oscillation or consolidation. Then there are periods of breakout, where it makes a strong move, either to the upside or to the downside, which happen roughly 16-20% of the time. And then the remainder of the time, we see periods of trend, or a trending market, or an underlying. This applies to all markets, all types of underlyings, over the long term, over a large sample set of data. Okay, so again, oscillation and sideways choppiness happens the majority of the time. We have breakouts, and then we have trends. And there are different types of trade strategies for each of these types of market cycles. This can be applied intraday for day trading, as well as on multiple days or multiple weeks or months on swing trading or position type trading basis. So again, oscillation, breakouts, and trends. It's important to understand where you are, where your stock is, where your market is that you're trying to trade, so that you make sure you're using the correct strategy. For example, you wouldn't want to try and take a reversal trade in a breakout period or in a trending period, because you never know when that trend's going to end until it's very obvious and clear that the trend is done. Okay. Your safest bet for reversals is during periods of oscillation where it's chopping in a range. Okay. Likewise, you wouldn't want to try and take a breakout or a trending trade in a period of oscillation. That also is, you're going to see, you feel very frustrated when you don't see the results that you think you should be having, or you maybe been told based on someone else's information, or maybe even research and backtesting you've done. So things to keep in mind. You want the right strategy for the right type of market cycle. Candlestick patterns. Now I'm not going to go into a whole lot of depth and detail on different candlestick patterns. There's lots of videos, information, whole books on this subject, but I'm just going to be going over just a couple of the most common ones that I utilize in my type of trading. So this is a list of the most common ones, and bull flags, bear flags, flat bottoms, and flat tops is what I tend to look at the most. So this is an example of this was a bear flag, and a bear flag. So this is a 1 minute chart of Apple. This candle right here, for example, it breaks and makes a new low. So if we entered on this candle here, our stop loss would be here. So sorry about that. Risking this much to ideally make this. So this is risking 1 to make 2. Moving right along. So more examples of patterns. So this would be a bull flag. So we have a pullback, and then right here, this 1 minute candle makes a new high and breaks out to the upside. So this would be a good breakout momentum strategy. We also see an increase in volume here. It's an example of volume analysis. We're looking at price action and volume. Again, for day trading, those are the two most important things to pay attention to. It's price action and volume. Swing trading, it's also important, but especially day trading. Technical indicators are least effective with day trading, most effective with swing trading. So again, price action, we have a pullback, bull flag, and breaks to the upside. And so here are more examples. So on Microsoft, this would be a flat bottom breakout, a flat bottom pattern with a breakout to the downside. And here, this is the same Microsoft stock on a 5-minute chart and the same price action on a 1-minute chart. So this is what this looks like on a 1-minute chart. So again, we have that flat bottom and then a breakout to the downside. Price action. So again, some traders only use price action to make their trading decisions. The less indicators, the better. Again, especially for day trading. So on this chart, we have the blue line representing the 9 EMA, the 9 exponential moving average, the yellow line on this one representing the 20 EMA, and then the green line is the 200 moving average. Also, the VWAP is one of the more important ones for day trading. Trend lines. So these are examples of different trend lines. So this one here is an example of drawing a level of resistance. So if that stock is trying to break to the upside but it can't, that's resistance. And if it was on the bottom side, a level of support. Okay, this is a trend line looking at the trend to find levels of support where it touches and bounces, and then finally touches and breaks through. So this is where this is an uptrend, and then the trend is broken and the stock reverses. We also see a 9 EMA crossing over the 20 EMA here on this one. So again, this is a level of resistance, a level of support in an uptrend, and then this one is showing you how to determine your risk to reward. So on this bull flag, we have a pullback to the 9 EMA, and then this green candle here, we see an increase in volume with the price action breaking above the previous candle. So the stop loss might be at the bottom of this previous candle, risking 1 to make 2. So in this case, look at risking 65 cents per share to make $1.30 per share. That would be the target of 2R relative to your risk of 1R. Volume analysis. Again, when the stocks make, or underlyings like the gold futures contract in this case, make a big move to the downside, we saw a big increase in negative volume or selling volume. And likewise, when we see big moves to the upside, we see increases in volume, right? We have pullback and the increase in volume to the upside, pullback, and then an increase in volume for a strong move to the upside. And if you're not familiar with this, these outer lines are the Bollinger Bands, just for example. So this is the TTM squeeze on top of the RSI and the ADX. That's how I like to have it on my screen, just so I see the strength of the trend, the general direction of the trend, and what the squeeze is saying is getting ready to happen. More examples. This is the gold ETF, GLD. We see that squeeze pattern right there with a strong trend to the upside and the price action. Psychological analysis. So you want to make sure that you're maintaining a good trade journal. Whether you're day trading or swing trading, it's really important we maintain a journal. You can only improve that which you track and know. So by keeping an accurate, detailed trade journal, you're going to be able to see what's working and what's not working, where you're making mistakes and what you need to improve upon. You can then fix those individual problems one step at a time, one thing at a time. When I first started trading, one of my big things, like all beginners, is having trouble with cutting my losses. And I started learning about that stop loss, how to pick your stop loss level and making sure to stick to it. You know, if you enter a trade and the trade starts to go against you, the beginner's mistake is to hope that it comes back and keep holding on to it as it becomes a bigger and bigger and bigger loss. With trading, it's all a numbers game. It's all statistics. If you have a strategy that is proven to work over a large sample set, the odds are in your favor, then you know to stick to those statistics and those mechanics. So you cut your losses quickly at that stop loss level when it gets hit. No exceptions, no questions asked every single time. So that was the first thing that I had to work on. And once I got that, that was a huge milestone for me. I knew at that point, it's like, you know what? I may be making all these mistakes, but at least I started cutting my losses quickly every single time the same, being that consistency, cutting the loss as soon as I reached that target. Then the next step for me that I had to figure out and learn the hard way was to be consistent with my trade size. So it doesn't matter if you're trading a $3 small cap stock or a $200 large cap stock. You can risk the same amount on each individual trade. And if you don't understand that, then you really need to dive into that subject and learn about that. Do some major research on that topic to fully understand what that means. And I'll make more videos down the road in the future on that subject alone because it's so, so very important. Again, you could be trading a $3 stock or a $200 stock. It doesn't matter. If you're taking a day trade, for example, you can risk the same amount on an individual trade. For example, $3 stock, if you risk 30 cents per share, that's a 10% risk, right? Then you're hoping to make 60 cents on that stock, right? And you're going to take so many shares. If you have a $200 stock and you're risking 50 cents per share, the number of shares you're going to take is going to be different, right? But the risk should be the same, which I know that may not make sense for me just explaining it in this presentation, but it's really, really important that, for example, on every single trade, if you're willing to risk losing a maximum of $100 on the trade as a whole, you need to figure out, okay, how much am I risking per share? And then how that determines how many shares that you take of stock. It's really, really important that you're consistent with that. So again, for me, that first milestone was cutting my losses at the same level every time. The second major milestone was determining exactly how many shares I'll be taking on every single trade to make sure I'm risking the same amount every time. As a beginner, the great thing is that commissions are free now for most platforms. So you can, if you're going to work on day trading, after you practice paper trading for several months and you feel comfortable, then you can move to the real thing and risk something super small like $2.50 or $3 or $5 per trade. And by doing that, you help yourself develop the discipline and the skills necessary to succeed in trading. Because in the beginning, it's all about the consistency and the discipline and the patience that you need to succeed with trading. It's so difficult. It takes so much time and practice. You know, if you're really good at trading, you may be taking, especially as a beginner or novice trader, one or zero, I should say, zero to maybe 5 trades a day. That's it. If you're day trading, if you're swing trading, maybe you're doing a handful every week, right? So it's really, really important that we start super small and focus on the discipline to be consistent. And then as you track your results and you see you have proven you have a successful track record, then you can scale it up over time. There's no need to rush, especially with now that trading commissions are no longer, are virtually not a thing, or not something we really have to worry about as a beginner. So really important to maintain a trade journal. These are the things you want to include at a minimum. Obi-Wan Kenobi, so you must be mindful of your thoughts, young trader. They will betray you. So another reason to keep track of all the details of your trade journal, track what you're feeling or what you're thinking when you took that trade. Because it's so easy, especially if you're day trading, to just get your brain to get in this haze and this funk, and you start making dumb decisions. You're like, why did I even do that? I know better. And I made that same mistake 100 times the last couple months. Why do I keep doing that? You have to be able to take a break, take a step back, really analyze and search your brain and your heart, because there's a lot to trading on a psychological basis that you have to overcome. Overcome the fear of loss, the fear of being wrong, the fear of missing out, greed, impatience, all things that have to be worked out of your trading regime in order to succeed. Psychological analysis or your trade psychology is the very most important aspect of trading. That's what's going to determine your ability to succeed or not. And with that, trade management is also the single most important aspect of trading. determining how many shares to take so you're risking the same amount every trade, knowing when to get out for a loss, to cut your losses, and what are your profit targets, and being systematic and the same, identical every single trade. So hard to get to that point, but once you get there, you have a great, promising future with trading ahead of you. And this is the last slide of this presentation. Profit expectations. How much can you expect to make with different types of trading activities? Being realistic, okay? So if you're doing covered calls and cash secured puts using stock options, kind of a hybrid method with investing, if you're picking great companies and you're doing it correctly and you really know what you're doing, a healthy expectation, 15 to 25% annually on average, we'll say. If you're using a variety of stock option strategies where you're just swing trading and selling premium, then 15 to 40% is probably a realistic expectation. If you're a professional investor or trader, 40%, and the sky's the limit. There's really no limit. And these are just expectations based on assuming that you've put in the work, you've studied, you've developed the skills and the discipline necessary to succeed and attain these numbers. But these are attainable and very realistic. Definitely better than your average 10% per year with a 16% variance or standard deviation, I should say, the swings and volatility in your overall portfolio with just investing in the S&P 500 as an example. And then with swing trading, depending on if you're buying stocks outright or using options, buying options, as I say, buying option strategies to swing trade, you can make definitely well over 100%, 200% or more, 1,000% per year. It just really depends on you and your risk and your skill set and how you approach it. Day trading, same thing. You can make well over 100% per year, but you can also lose everything that you have to in your trading account. So not to make light of it or make it sound easy, because it's not. But technical analysis is useful. I'm going to go back to the very first slide, first couple slides, I should say, and just a quick look here. Again, different types of analysis. Fundamental analysis for investing, statistics, quantitative analysis for stock options, volatility analysis as well. But for swing trading, primarily looking at these. For day trading, really it's price action and volume. So that's a quick introduction to technical analysis and what it is, how it works. I hope you learned something. I know this is, if you're brand new to trading or technical analysis, there's a lot that maybe didn't make sense, or if you know a little bit about it already, hopefully this was a helpful video. So God bless, grace, peace, and until next time, I hope you guys learned a lot. Talk to y'all later.